Welcome to The Foundry, where leaders are forged daily. Each week we investigate themes of leadership, entrepreneurship, and mindset with some of the greatest minds in real estate. And now, the data scientist of real estate, George Roberts.
Welcome back, entrepreneurs. Today, I have the pleasure of interviewing Sean DiMartile, founder of Takeoff Capital. Sean left his high-stress job as an air traffic controller to pursue his dream of becoming a full-time real estate investor. He took the plunge by liquidating his 401k and using all his savings to purchase a 32-unit multifamily apartment out of state. With his initial investment tripling, Sean expanded his business, completing 2 large syndications and growing his portfolio to 300 multifamily units, a 10-key hotel, and 4 Airbnbs. His podcast, where he shares his journey and insights in real estate investing, has over 200,000 total listens, and he's built a network beyond expectations. Welcome to the show, Sean.
Thank you, George, so much for having me on the show. It's my pleasure.
Well, I'm excited to have you here for a lot of reasons, including the fact I love Airbnbs and I'm just fascinated by these accessory dwelling units. And I think most people have heard about them, but many people may be frightened of investing in the state most famous for its ADUs, California. So why don't you tell us why California, what are ADUs, and why is this the new gold rush?
So thank you so much for asking about that, because that is what we're focusing on right now. So first, what ADUs are, just as a reminder to your listeners, it stands for accessory dwelling units. And California really paved the way with accessory dwelling units by putting in that in the municipal code. And all it really is it allows you to add additional dwelling units, additional rental units to a property. Normally, this is, designed for adding to either single family or multifamily properties. Now, statewide, in general, you can typically add 2 ADUs to a property. These are, traditionally, these have been like converting a garage into a rentable unit and maybe another detached one in the backyard or something like that. Now, here in San Diego, the strategy we're focusing on has expounded upon that. And to provide some context, San Diego has one of the worst housing crises in the nation. It's currently the most competitive rental market in California. On average, 17 renters are competing for the same apartment. The median home price here is right at $1 million. So it's become extremely unaffordable for people to own here. So what's happened, though, is San Diego is geographically constrained by the ocean to the west, Mexico to the south, expensive mountainous terrain to the east, and then Camp Pendleton military base to the north. And all of the vacant land, for the most part, has already been taken up and built on. So the city needs to drastically increase the amount of housing to meet demand. Now, to demonstrate how far behind they are, San Diego needs to more than triple the number of housing units that they have been adding every year up until 2029 in order to meet their housing goals. So the reason why they've taken that ADU model and essentially expounded upon it, and they call it the bonus ADU program. So what they've done, and there's a lot of minutia with this strategy, but essentially they've created a map of what they call a transit priority area. So anywhere within a half a mile of major public transportation, you can use the bonus ADU program, which allows you to build an unlimited number of ADUs up to the floor area ratio of the lot. So in essence, what this means is you can purchase a small single family home that's on a multifamily zoned lot, which is key, because you can add additional units to a residential single family zoned lot, but not that many. But if you are able to get the right lot, you can take a single family home that exists on that lot and turn it into a 10-unit apartment, 20, 30-unit apartment. And these will sell, get lended on, trade, everything just like any other multifamily.
Quick question for you now. You actually keep the original home, or are you knocking that down to build?
In most cases, we're keeping the original home for a number of reasons. Typically, if you completely demolish the home, there's going to be more permitting. There's a little more hoops to jump through if you do that. So typically what we're doing is we're like, for example, we might take a house and that might be a 3 or 4 bedroom house and convert that into 3 or 4 single bed or 1 bedroom apartments, and then add a structure in the back. Another example for a home that we actually have about a half a mile from the beach, we converted an extra room into a studio, and we're building a 10-unit, or excuse me, an 8-unit apartment structure in the back of the lot. So it's going to total 10 units once it's completed.
Yeah, and San Diego, when I think about San Diego, it's known as America's finest city. And most mottos, I think, are complete junk. But having been there, I got to say that's very, very true. It's a beautiful city. And sounds like it's just become a victim of its own success. So many people wanting to move out there, actually having, in some ways, some laxer code than other cities in California. A little surprising. Usually it's the other way around. The nice cities are trying to stay nice by keeping their code, super difficult. But again, California really has had a lot of troubles because they made it just so hard to build, and now people are actually leaving. Unfortunately, very very sad story. But glad to hear that there are not only some light in the tunnel, but opportunity for some people like you to make some profit by serving people.
Absolutely. And I kind of wanted to touch on, if you don't mind, like what you had alluded to at the beginning, like, California, oftentimes, most real estate investors, bigger ones, will tell you that they avoid California, especially if they've never lived here, et cetera. And I also want to touch on the point you made about, there being a net outflow of residents out of the state of California. And I would say that it really depends on the city and the market, because that isn't the case for San Diego. San Diego's population is growing, especially depending on the submarkets you're looking at. San Diego's job growth has outpaced the national average for the past several years. It's now the third largest biotech hub in the nation, next to Boston and San Francisco. It's also got the largest military presence in total on the planet, and that's only growing due to the Pacific pivot because of the Chinese threat. So a lot of jobs have moved here, especially high-paying jobs, which has only increased the demand more. Now, when it comes to like, okay, well, what about California? It sucks being a landlord there, right? Yes. And that is the main reason why I wasn't really interested in investing in San Diego, California up until now. Because if you're going to do, for example, a value add multifamily in San Diego, it's much harder to kick out a tenant that's been living there and tell them you don't want to renew so that you can then renovate the unit and implement your value add plan. Oftentimes, landlords will even account for cash for keys and giving money to the tenant just so they can move out, so they can renovate it. So all of those concerns are valid, and one of the reasons why I haven't been interested in value add multifamily. Now, with this strategy, though, I am placing all of the tenants myself. So there's much less risk in me inheriting a really bad tenant that I can't get out of there. And I'm putting brand new product on the line as well in neighborhoods that otherwise hardly get any brand new product. And as an example, that project I alluded to that's a half a mile from the beach, there have been 0 new apartments built there in the last 3 years, 0. So in that specific submarket, last June, the vacancy rate actually dipped below 1% for the first time. So you have just enormous demand. It's easy to fill up these units. I can put them in prime locations, and I don't have to inherit bad tenants. So that's why, some of the many reasons why I love the strategy in California and San Diego specifically.
And I love that you mentioned that because I was going to ask you about the supply side. I think it's extraordinarily important. Supply side is really what's driven all of these extraordinary profits over the last several years. I mean, namely that we haven't had any supply at all. Understanding that supply and demand is very, very huge. And I just found it shocking when I was reading into your story about how you're able to actually go into places that have literally no product coming online. And then you're able to go and you're able to build and not have a whole lot of competition. Well, you did mention California as being maybe a difficult place to invest in, maybe not a great place to be a landlord, perhaps a great place to build if you have the right strategy. You want to talk a little bit about the rest of California, because I couldn't agree with you more. People sometimes look at states and, maybe they break them down into blue states, red states, or landlord friendly, not landlord friendly, et cetera. But California's a big state. It's heterogeneous. You got parts that are very warm and other parts not so much. And you've got, you got mountains and the ocean, you got inland empire, and you got your big cities. Like, what do you think about some of the other markets like inland empire?
Well, I know Inland Empire has done really well for a lot of developers and owners over the past decade. I've had several owners in that area on my podcast that have talked about it. But me personally, I'm not interested in places like Inland Empire because of other dynamics. Now, a lot of people choose to live in Inland Empire because the homes are more affordable, right? And then they will commute from Inland Empire to wherever their jobs are, oftentimes LA. I've even worked with people here in San Diego that commuted all the way up to Marietta and other areas in Inland Empire just because they could afford a home up there. And that's more of the norm. But for me, the long-term view of that is that I think, as a multifamily investor, I want to focus on the places that have the high paying jobs a lot closer to them. Because like I like to target A and B class, construction builds that I'm doing here. And I want to capture those high income earners, those biotech earners that just moved here that want to rent a really nice apartment that's brand new, that has in-unit air conditioning and washer and dryer and all that kind of stuff with some ocean views. That's what I want to target. Places like Inland Empire, I know people have done well, but I just don't see the long-term vision there with job growth, population growth, et cetera. And then most of the rest of California, I feel the same way about. I'm not interested in investing north of San Diego because there's a lot more added risk. The same reasons why I think there's a lot of added risk in value add multifamily here. It's so much harder to underwrite a property that you're buying if it's really hard for you to get the tenants out, because it's not as simple as saying, I don't want to renew your lease and that's final. I am going to do a renovation. So how do you account for that? Like, how do you make your assumptions on how many units you're going to renovate per year or per month? And because of that, and on top of that, put it this way as well. In California, in most of the markets, you're going to be paying north of $400,000 per unit for a multifamily property, almost anywhere. Whereas I can build these units brand new for on average around $200,000 per unit, depending on how big it is and what the unit mix it is and several other factors. So as long as you're an investor that's willing to go through that period of not having a lot of cash flow, because typically it's going to take me about 2 years before it's fully built. If you're okay not relying on that cash flow for that time frame, you can make a lot of money here in California using this bonus ADU program and developing your own units. So that might be a long-winded way of answering that question. I'm sorry, I think I went on a tangent there, but yeah, I'm not really bullish on the rest of California. And here's another thing I wanted to mention. LA and San Francisco Bay Area in particular are having a lot more net out migration. And San Francisco and the Bay Area, the number one place for them to move to outside of Sacramento is San Diego. And they get that data from U-Haul trucks, right? Where they're being picked up and then where they're being dropped off. And so a lot of those markets are actually moving to San Diego because I think they're thinking a couple of things. One, those other cities, their policies with transients and things like that are not as strict as San Diego. Those markets have been going downhill, and they can live essentially in a better place that's cleaner and not overcrowded yet. So a lot of people are coming here.
Yeah, love it. Yeah, definitely a lot of heterogeneity in the markets. Well, I'd like to take this as an opportunity. Let's get to know Sean DiMartile a little better. You listed your three greatest strengths as underwriting real estate assets, analyzing market data, and building relationships. I'd love to hear more about analyzing market data. So tell us what attracts you to your market. How do you analyze the data? What are some things that you're doing that you think other people should be doing more of?
So I look at a whole host of things. I like, first of all, starting at looking at what the median household income is. Like here in San Diego, I like the neighborhood. I have very specific neighborhoods that I'm interested in investing in. And these are neighborhoods that have $80,000 plus median household income, areas that have strong gentrification, decreasing crime rates and things like that. I want access to all of the major attractions and things that these people are going to want to do when they're living here. Those are givens. But when I'm looking in the starting to get more granular on the data, I like to look back over the past 5 to 10 years and see what the rent growth is, what the vacancy is by bedroom. So for example, I'm building units here and I'll look at that submarket and say, okay, like the North Park submarket, for example, there's been a huge supply of units and a lot of those have been studios. So studio vacancies are double what the vacancies are for 1 and 2 bedrooms. So
Yeah.
I'm not going to be building any studios in North Park. And that's very, very useful data for me. I also like to look at the amount of deliveries and construction starts. Because if I'm going to put some new units in a neighborhood and there's another couple hundred coming online right around the corner,
Yeah.
I know that I'm going to have a lot more competition here soon. I like to look at, the cap rates over time, because over the past couple of years, a lot of markets around the country have had very low cap rates. Take, for example, I even have 295 units in Greensboro, North Carolina. Now, the cap rate in Greensboro, North Carolina, about a year and a half ago, got all the way down to sub 5. It was like a 4.8 cap or something like that is what properties were trading at when we had those interest rates at rock bottom. But if you look at the data historically, that is an anomaly. The cap rates are rarely, they may never get that low again in Greensboro unless interest rates are that low again. But when you look at a place like the Central Coast submarket here in San Diego, California, there's not a lot of variation. It will hover on average at around a 4 cap over time. And I think this is a good time to point out too on what cap rates, when we're talking about cap rates in multifamily, not only obviously we know what the formula is and how it relates to the value of a property, but it's also a market's assessment of risk. Because the lower the cap rate, you're supposed to have a lower risk of that property essentially being able to rent out for what you wanted for, stay at relatively the same, pricing and cost per door, et cetera. I know that here in San Diego, California, the cap rates aren't going to adjust back up to a 6.5 cap or a 7 cap like they might in some of those secondary and tertiary markets. So I'm saying that because if you are analyzing your deals and you're looking at cap rates, look at the historical cap rates to give you a better picture of where that market's been. And I always recommend at a minimum, you add 0.20 to the cap to today's cap rate for each year of the hold that you're going to be holding the property. So, that's a couple of the reasons. I don't want to go on too long of a tangent here. I tend to do that, but I like to look at tons and tons of data. I look at the schools, walkability, and I kind of put it all together to try and make an informed decision.
Yeah, outstanding. Yeah, schools, walkability, jobs, income, housing prices, all very good. But I love the fact that you're mentioning things like the supply coming online, absorption. These are things I think a lot of people really need to pay a much closer attention to.
Absolutely. I couldn't agree more because it depends on the market. Like, for example, there's markets in Texas, like Dallas, for example, where there has been an enormous amount of new supply coming on. And over the next year, there's an enormous amount of new supply coming on. But those Texas cities have an advantage that places like San Diego don't. Like in Texas, you can essentially just build out communities infinitely because it's a ton of flat land, right? You can't do that here in San Diego. The only place where we've seen a substantial number of new multifamily coming online is downtown San Diego. And outside of that, there's hardly any. So downtown San Diego does tend to have a higher vacancy rate than the rest of San Diego, simply because they have way more units here. But not everyone wants to live downtown. A lot of people want to live by the beach, which is why that maintains the lowest vacancy that I've ever seen. So
Yeah, well, love the beaches out there in San Diego, so I can't disagree with people following that approach. Now, let me ask you, you did mention the huge differential between the price to buy versus the price to build. That's incredible. Talking 200 per unit versus 400 per unit for existing. Definitely a major inducement for the people who do have the ability, the wherewithal to go out there and build. And again, in some places it makes more sense than others. San Diego attracting population obviously makes some sense to do that. Now, have you completely shifted your approach? Are you focused only now on buying and then, I'm sorry, on building and then selling, or are you interested in operating these after you build?
We're doing both. So some of our investments we're offering as basically a flip. We're going to build these and we're going to lease them up and then sell them so that we can turn a quicker profit for our investors. And some of these are going to be 5 to 10 year holds. And I say that just because we've polled our investors, talked to our investors a lot, and we have just mixed desires from our investors. Some of them, are investing their money and they would prefer to have that money turned a little bit quicker. And then other parts of our investors, like family offices and especially more high net worth investors, prefer that we hold on to the asset for a longer period of time and ride it out and, or develop even more value to sell it later on down the road. So we're trying to cater to what our investors want, and so we're doing a little bit of both. But typically it's either a 3-year hold or like a 5 to 7-year hold.
I love it. And yeah, that bonus ADU program, pretty cool. 5 to 30 units. So those are some pretty decent sized apartments, especially when you're considering that's going on to some residential property. Let me see if we could pivot just a little bit. I'm also very fascinated by Airbnbs. This is something that everybody knows has had a huge jump out of the gate since 2020, since the pandemic. We've seen a lot of bad things happen to hotels, but people are still out there moving around, going out and enjoying life, going on vacation. A lot of people moved into these Airbnbs, maybe a little too much. I know some cities are clamping down on that. A lot of people have gotten stung. We now have talk of there being a sort of an Airbnb glut. Where do you see the market going from here?
I think I'll start by saying I think a lot of the Airbnb bust rumors that people hear online and the tweets that get shared like wildfire and stuff are a little bit misguided. First of all, Airbnb, like the first half of this year, Airbnb had more people using their platform and renting Airbnbs than ever before in history. Now, there's also more supply than ever before in history. So I think that moving forward with Airbnb, and I can tell you from my experience, my Airbnbs are still crushing it. They're doing really, really well. That's primarily the cash flow that I use to fund my lifestyle these days. I think that what's changed is that you can no longer just buy a 3-bedroom house, throw in some furniture yourself, take some photos with your camera, throw that up on Airbnb and make a ton of money. Those days are gone because those are a dime a dozen. There's thousands and thousands of Airbnbs just
Right.
like that. Now, I think the really good operators are still absolutely crushing it. I mean, my properties so far this year, when we're not even at the end of the year, are already over a 25% cash on cash return across the board.
So
So
what's the most important aspect of a good operator as you see?
the most important aspect of a good operator, I'll give you a couple. Number one is pricing strategy. I think so many operators fail at understanding how to properly price their property. And what I mean by that is they'll have a bunch of really expensive days. It'll say $600 a night, Monday through Friday, and then $700 a night on Saturdays and Sundays. And they're wondering why they're not getting any bookings. Well, that might be what you value your property at, but your property's nightly rate is worth what people are willing to pay.
Yeah.
So if you're not getting bookings, you need to start dropping down your prices. I mean, if you would have made those $250 a night on that example instead of, $500 or $600 a night on the weekdays, you might at least make some money instead of no money. But those little numbers add up over time, and especially when you're talking about over a 30-day calendar. I think that So I like to use a third-party website called Price Labs, and then I'm able to adjust my pricing dynamically based off of demand. This app will even tell me if, for example, there's a Taylor Swift concert on a certain weekend or something so that I can adjust my prices accordingly.
Love it.
So those kind of things are just paramount to be able to make good money and compete in the marketplace. I can look at certain days like a weekend and I can see what the 50th percentile is booking for, 75th and 90th percentile. Then I could look back at my data and kind of see where I was within that percentile in past months or the prior year. And then I can, assign my pricing accordingly to ensure that I get booked and I make some money. I think another thing too, that's really, really important is setting yourself apart with the amenities. So, and I'm going to give you an example. My Indianapolis property, which is a 5-bedroom, 6-bath, brand new build, luxury Airbnb. If you were to look at Airbnbs that can sleep 12 or more people, that have a pool, and that also have a hot tub, there's only one property in the greater Indianapolis area, and it's mine. If you look at properties that can sleep 10 or more people that have an electric vehicle charger. There's one, it's mine. So if you want to really make sure that you're getting tons of views, tons of clicks, you have to have things that make your property unique. So like that property has a shipping container that was converted into a pool, and it's got a big glass window in it for people to swim in. So now I come up on amazing pools whenever you're looking at Indianapolis. I think that moving forward, if you're going to be an Airbnb operator, those are the kinds of things you have to look at. What did the competition have? This is easy data to get. I can see the percentage of Airbnbs that have a hot tub. I can see the percentage of Airbnbs that have an EV charger. I can see a list of all of the top amenities that are in demand using a platform like Price Labs that I mentioned earlier in that market. And then I can set myself apart by providing those amenities that are the most sought after that other Airbnbs don't have.
So that's great. So then I want to thank you, Sean, for being such a very open guest and sharing your knowledge and experience with our audience.
Thank you so much for having me. This has been a pleasure and an amazing conversation. Thank you.
Likewise.